Long. Got it. Okay. I don't know if I got that pop up, but this is going to be recorded just so that we can let other DPR agents see this later who couldn't join with us live. So Sheila Long is here from Old Republic Exchange, and so she's an expert at the 1031 exchanges, and she's going to be speaking to you all about that. Now, Sheila, real quick, somebody had asked how long this class is, because a lot of our little webinars that we do are about 30 minutes. How long were you expecting to have this go?
Well, we can cut it down to 30 minutes. You'll just see me go through the slides a little bit faster. I was thinking it was going until 2. So if we'd like to cut it down, we can.
I kind of thought this would be an hour-long class, but I'm just saying we do other marketing little segments and stuff for 30 minutes. But yeah, if this is an hour-long class, I just want to give everybody that expectation right now going in.
Yeah, and I think we can get done in time. I typically am around 45 minutes, and so we'll kind of base it on that and plan on closing up by 2.
Okay, that's great. First of all, Beth or Melinda, was there anything you guys wanted to add before we turn it all over to Sheila?
I just wanted to thank Sheila for teaching the class today. We really appreciate it. I know she's done a lot of classes for us. We've had excellent feedback. I find this is going to be a very high value class for everyone attending, and we're grateful to have Sheila on. And again, if you do have to leave early, we'll send you the recording, and then look forward. We can always do more classes down the road with Sheila. So we're really excited to have her on board, and I want to say thank you.
I'll ditto Beth. That sounds good. Let's get started.
All right, go ahead, Sheila. Thank you.
Sheila, you're on mute.
Yeah, you're muted, Sheila.
I just had all that and you guys couldn't hear me. Sorry. So, well, hello everyone, and thanks for making time. I'm already seeing some attendee names that I recognize, and this class is really for you. So if you have questions, put them in the chat box. I'll ask that maybe Becky or Beth can answer those questions, or feel free to interrupt me, okay? Because this class is really for the agents. Again, my name is Sheila Long, and I am the regional executive with Old Republic Exchange, and I'm here locally in Arizona. But I actually specialize in understanding state-specific tax rules of the 1031 exchange, all the way from California and through the mountain states and the Southwest. So with that being said, I am going to point out some great tips that some of our own tax advisors make mistakes on. Okay, so in a normal world, I always say this, right? I used to run around and teach this course up to a dozen times a month in person. And I'm actually kind of liking these Zoom classes now, but I teach it not only to realtors such as yourself, but also to CPAs and some attorney board associations as well. So I've given a lot of knowledge, and I get a lot of knowledge back from CPAs and tax advisors also, and I'm going to share some of those tips with you. With that being said, I'd like to start and say that everyone has their own role in a real estate transaction. And I think this is important for you to know, because as you are maybe the listing agent, right? Maybe there's a buyer's agent. If your client's getting a loan, there's a lender involved. There's always escrow and title, right? And this is where my team over here at Landmark comes in. And if your client is selling investment held property and they have any sort of equity that they want to defer the gains on that equity, they also need what's called a qualified intermediary. Why am I pointing this out? Because so many times sellers get to the signing table, right? They're over there at Landmark and they're like, how does this work? How does the exchange work? And the escrow officer is stuck going, wait, we are not a qualified intermediary. So you do need to understand, whenever you have a client that's selling investment held property, so if they're selling land, commercial, or residential, that's not their primary home, they also need what's called a QI. Qualified intermediary, known as an exchange accommodator or an exchange facilitator. That's our role. What do? We prepare the exchange agreement, sending it to all parties to sign at closing. We coordinate with all real estate agents, tax and legal advisors. And most important, we hold the proceeds so that the seller You'll hear me say taxpayer or exchanger. In my world, that's what they're called, the taxpayer or the exchanger. We hold the exchange funds so that they don't have what's called constructive receipt. Really important that you know this, agents, okay, that your sellers are unaware that escrow cannot hold those proceeds. Even if, say, Landmark is holding the funds on what's called the relinquished property sale, but that yet ABC Titles is going to close escrow on the replacement property, we still need to have, your seller still needs to have a qualified intermediary in between their funds and both escrows. So really important that you understand that that is our role. My specific role, not only do I run around and teach this course, but I also handhold your clients to make sure they understand the strict guidelines and the even tighter timelines. So with that being said, what are we going to discuss today? So we are going to talk about what is a 1031 exchange, what qualifies, hazards and timelines. I'll address a little bit when we get to the capital gains, sort of what our feelings are with the new administration and some of the potential changes. Okay, so we'll address that for those of you that are interested in joining this class today to hear sort of what our thoughts are on that as well. With that being said, before I go into my next slide here, okay, what I want you to know is, even though I'm giving you a lot of information in this course, I want you to understand there are only going to be 5 Realtor rules I want you to remember. Only 5. Okay, I want you to remember 5 Realtor rules. I'm going to repeat those so you retain them. Okay, and remember again, the teammates on this screen have brought you this class for education purposes, but there are only 5 tips you need to know to be successful. Okay, with that being said, there are 3 general requirements that you must know. Both the property being sold and the one being purchased must be held for investment. So remember, we're talking about anyone that's selling commercial, land, or residential that's not their primary home. Remember that. Any investment held property that is sold, so long as they buy again investment held property, they can perform a 1031 exchange. Both properties must be of like kind. And that is a term we're going to pick apart in a moment. Okay, I want you to hang on to that and know. Okay, just remember this. Both the property being sold and purchased must be of like kind. And there must be an exchange as distinguished from a sale and a purchase. What does that mean? It simply means, again, remember, in your contract or in an addendum before close or with our exchange agreement, all parties must be notified that the taxpayer is doing a 1031 exchange. That's it. Okay. I get the question all the time. I didn't put it in the listing. My seller just told me they want to do a 1031 exchange. That is okay. Remember, it just needs to happen before close of escrow in order to qualify for the tax deferred exchange. So what is a 1031 exchange? And I am not going to read you this. I always paraphrase so that you can understand it. Okay. The 1031 exchange is a tax code. It is for anyone selling investment held property. And what did I say investment held property is? Right? Land, commercial, residential, that's not their primary home. See, the primary homeowner is exempt from another tax code, right? They're exempt from their gain. If they are an individual, right, and they bought that house, that property that they live in as their primary home, they're exempt under a different tax code called the 121. If you remember from real estate school, that means their equity, if they're an individual, can go up to $250,000 before they would pay tax on that, or $500 if they're married. Well, anyone holding investment held property does not have any exemption, any sort of exclusion, unless they perform a Section 1031 tax deferred exchange. So again, anyone selling land, commercial, residential, that's not their primary home. The IRS states that so long as they sell, and here comes your first tip, so long as they sell for equal or greater in value of what they bought for, right? So they sell for $500,000. Let's give easy numbers here, okay? So let's say your client sells. If they sell and buy again for equal or greater in value, they can have 100% tax deferral. So let's just say they sell for $500,000. That means they can go buy again. So long as they buy for equal or greater in value, they can have 100% tax deferral. Now, with that being said, I do want you to know that that's your first Realtor role here, okay? That when your client sells, they need to buy again of equal or greater in value. to have 100% tax deferral. Now, it doesn't matter if they sell one for 5 and they go and buy multiple, right? Maybe each one for 100,000 each. That's absolutely fine, so long as they get up to the equal or greater in value. Now, it's actually equal or greater in value less all allowable closing costs and expenses. And what are those? You know, your 6% commission, escrow, title, exchange fees. This reduces what they have to buy again for. So again, let me say this again. If your client sells for 500,000, they need to replace something called their basis. They need to obviously replace their gain, and they need to replace their mortgage to get up to the equal or greater in value. Remember that. Okay, they must replace their mortgage as well, either with a new mortgage to get up to value or bring in the cash difference. They also need to buy like-kind property, and we are going to pick that apart in a moment. But before we do, I always like to say, why would anyone exchange? Okay. Obviously, capital gains are fairly substantial, and I will show you a brief understanding of what capital gains are coming up here in just a moment. They can take those dollars and reinvest, right, into something that produces income. So take those tax dollars and put it into their own wealth growing. And they can diversify, right, and transfer from non-income producing property like land into something that does produce income, okay? Now, before we go into this next slide here, I want to let you know, remember, this class is for educational purposes. I'm going to show you what capital gains are because I think it's important all of you as agents understand why you should always bring up to your sellers the potential of doing a 1031 exchange. At least ask and tell them, right? And let the Landmark team know, because what happens is that, like I said earlier, your clients get to the table and they're asking the escrow officers, hey, how does that 1031 exchange work? And the escrow goes into a panic going, you were supposed to set that up. So I do want you to know before we go into this next slide, remember, you're definitely not quoting the current APR, right? Or the interest rates of the day. I know that, right? You're like, call my lender partner. I also want you to know, don't quote this next slide that you see. I just want you to have an understanding of what capital gains rates are. Capital gains, all of us as taxpayers, we are taxed on the federal, we're taxed on the state, we're taxed if we're in higher income brackets, and we're taxed on something called depreciation recapture. So important for you to understand this, okay? That this is something that unless your clients perform a 1031 exchange, if they're selling land, commercial or residential, that's not their primary home, they will be taxed on all of the below, okay? Here in Arizona, we're taxed at 4.5%. And I always joke, if any of you have been in my classes before, you've heard me say this every time. If you're wondering why so many Californians, right, are coming here in airplanes, trains, and automobiles, it is because the great state of California has figured out how to collect the highest tax in our nation. So do understand, this is why anyone would ever perform a 1031 exchange. See, the IRS states that all of us taxpayers are entitled to a 1031 exchange so long as we set it up in advance. Now, I do want to pause right here for those of you that are wondering, okay, as you have heard, maybe some of you have heard, the new administration has proposed a cap on the 1031 exchange as a way to fund their potential policies. And as a qualified intermediary, it is our where we're standing right now to say there are far too many unknowns to be creating fear. Now, the new administration is saying, hey, like the primary homeowner, right? Let's cap them after 500,000. Maybe they get their first 500,000 exempt under the 1031. Then the rest is subject to capital gains tax. We'll see what happens. We are all lobbying and advocating that it does not change. It has shown to be more hurtful and harmful for our economy if they are to remove this. But as of right now, and as of today, if you're wondering why you are seeing so many more exchange transactions happening, it's because everyone's getting put into place, getting their investments, kind of realigned to see where they're at in case there is a potential change. And right now there's 100% tax deferral so long as when they sell, they buy again of equal or greater in value. With that being said, here's that term like kind I do want to go over. Remember, I mentioned the tax code states when your client sells, remember that first realtor rule? When your client sells and they buy again for equal or greater in value, right? They get 100% tax deferral. So remember I said if they sell for 5, they need to go buy again for 5. Remember the scenario all day, okay, guys? So if they sell for 5, they need to go buy for equal or greater in value to have 100% tax deferral. They also need to be buy of like kind property. And this is your second tip. And even one thing, if you take away anything from today, I always say that as well, it is the true meaning of like kind. See, like kind really means any real property held for investment. Any real property. What that means is you can have a client that is selling land and they can go buy commercial. They can take commercial and buy residential, right? Or an apartment building. They can take a single family and go buy 2 condos, right? Sell 1, buy 2. Okay. They can take a multi-vacation home, a multi-family for a vacation home, so long as it's rented out. And this is what I want to let you guys know. If you are not farming in this manner and you've got your Landmark team right here, I'm letting you know most of your clients or potential clients don't realize they can say, take that raw land and go turn it into any other income producing property. Why do I point this out and spend time here? It's because this is the common mistake most of our own tax advisors make. See, our CPAs and tax professionals are focusing on understanding all the accounting rules, all the different tax returns, all the changes from the last administration, and all the potential changes that may come with the new administration. They're not focusing on understanding every single tax code. As a qualified intermediary, we are only focusing on one, Section 1031. I have mentioned, and I told you I would tell you this, I have CPA courses as well, and I will sit with those CPAs, teaching them about the 1031 exchange. And this one area is where I always get pulled to the side, where the CPA states, I thought like kind meant basically the same make and model. It does not. So remember that. With that being said, also, I do want you to remember right here, multifamily or vacation homes. Okay, here's your third realtor role. Okay, I do want to let you guys know a second home typically could be challenged if under audit, saying that the taxpayer held the second home for personal use only. That's because they've never rented it, not even a day. See, there's a difference between a second home and a vacation home. Vacation homes under the code, the IRS states, so long as the taxpayer is holding that property for 2 years, 24 months, and they rent it out for 14 days or more for 2 consecutive years, it qualifies as like kind. This is a great opportunity, okay, for you guys to understand and know that it allows your sellers, okay, or your clients, or those of you that are on here that own second homes or vacation homes, it allows you some use, so long as you follow the rules, you don't over declare your use, right? And you are paying Uncle Sam his unfair share of the profits on the rent. Okay, that's what I get a lot is how do we make this work? You do need to make sure that you're renting it for at least 14 days or more, making sure if you're only renting it for 14 days, you don't over declare your use, which is the same amount of time. Or you can rent it out as much as you want. Okay, say it was a Airbnb in Flagstaff. You can rent it out as much as you want. Let's say you rented it for 300 days. Then you can declare personal use of 10%. Okay, 300 days, 10%, that's 30 days. Now do let me share something with you, okay? This is a nice little gray area. Declaring and actuality are 2 different things. Okay, so remember, over declaring your use for personal days are when your feet are up by the fire pit. But capital improvement days, so when you're up there, it's 120 down here in the valley, right? And you want to go up to Flagstaff for the month of July, you better be doing capital improvements on the property because those days don't count towards personal use. Great realtor role right here, guys. And that's your number 3 for the day. Okay, remember this, vacation homes qualify so long as they're rented out for 14 days or more. It is like kind. With that being said, I do want to go over just some basic terms, okay, so that you know and are aware when you see this timeline slide, because that's coming up. When you see the relinquished property or RQ, it simply means the property being sold. The replacement property or RP is obvious. It's the property being acquired. There are two timelines you need to follow, okay? And one of them is called the identification period, which is 45 days, and the exchange period, which is 180. And we're going to spend time on these bottom two here, okay, right now. So let's talk about the exchange timeline. And the exchange timeline, so that you understand, okay, starts the day your clients close on their property they're selling, called the relinquished property. Okay, important you understand this. And this is your fourth realtor role and something you do need to know about. Okay, you need to know that there's a timeline and rules of identifying. Okay, and again, for the sake of time, I'm not going to go over the rules of identifying, but I want you to know, remember in the beginning, I mentioned everyone has their own role in real estate. It's really important in a real estate transaction. It's really important that you know, and you have a good QI that will talk about these timelines, reviewing these timelines with your clients, so that all you have to do is help them sell and help them buy again. Okay, but do remember, okay, as your fourth little realtor rule, there's a timeline and rules of identifying. Again, this timeline starts the day they close. At that point, they have something called an exchange period, all right? That is 180 days. Now, this is just the amount of time every taxpayer is entitled to. Again, it starts the day they close. Now, not every real estate transaction takes that long. This is typically for someone that might be doing a new build, right? Those are some that take a little longer than the average 30-day escrow. Or those commercial agents, right? You take longer than the 30-day escrow as well. With that being said, there is a little tight timeline that will keep your clients up at night, and it is called the identification period. This 45 days starts the day your clients close on their property, right? Starts the day they close. Let me grab a little pen here for you guys. Hold on a minute here. Okay, so all these timelines start the day they close. Okay, the one that's going to keep your clients up at night is called this identification period, and it is 45 calendar days. Okay, it includes weekends, it includes holidays. There are no exceptions, there are no extensions. Really important that you understand this, okay? Because so many times your clients will ask, can I have an extension on this timeline? They cannot. It is 45 calendar days for them to identify what they want as that replacement property. And again, it starts the day they close. Now, as agents, we all know, right? As agents, this is a tight timeline. And I can't say this enough. This is one of those opportunities that if you have the listing of someone that is selling investment held property, right? So if they're selling land, commercial, or residential, that's not their primary home. I do want you to know, it does not trigger any taxable consequences if they identify a replacement property before their property has ever sold. Can't say that enough. It does not trigger any taxable consequences for them to go into contract. And the property that they're going to buy isn't even closing till 2022, excuse me, wrong year we're in, okay? 2022, okay? This timeline starts the day they close. So here's what you can do in this market right now, right? What kind of market are we in? In a seller's market. And here's what we're seeing that is happening, which is causing more successful exchanges than ever before. As we're in a seller's market, we are seeing more sellers negotiating the extension of closing so that they can find a replacement property. Okay, so I'm seeing contracts where they say 60 days or sooner. It's contingent upon the seller finding a replacement property. That's what I'm seeing on almost every contract right now. I want you guys to know that, okay? Because we love those 14-day close of escrows, but what happens when that property closes? There starts the timeline. And they have no extensions and no exceptions. They must identify what they're hoping to buy by this 45 days. Now, I spend so much time on this because I want you guys to know this is a big mistake a lot of your sellers make. A lot of you agents quote this timeline incorrectly. So do note 180 days is the exchange period, 45 days is the identification period. It all starts the day they close on their property, and there are no extensions and no exceptions on that. Number 5, and we're going right here to your 5th one right now. The number 5 most important basic rule that I want you guys to remember is that your clients must go into exchange agreement prior to close on their property in order to qualify for the tax deferred exchange. And it's really important you know this because a lot of times, again, your clients will say, call me and they'll say, okay, we just closed yesterday and my CPA said that I have 180 days. Now, what happens is the IRS states in order for them to qualify for the tax deferred exchange, the exchange must be set up before they close, preferably not at the signing table, guys. Okay, right now we're so busy, we are asking for at least 48 hours before signing in order to get this done. We can make it happen sooner, okay? We do rush. I don't want to charge any rush charges, so I am asking if you guys can, as agents, let your escrow officers know at Landmark that you have an exchange happening, okay? And then get them in the hands of good qualified intermediary. And I even say, let us know beforehand. And the reason why, there are so many tax saving tips that we can give you, so many tips that we can save them on. And some of those things could be prevented if we were able to get in touch with your client in advance. Okay, so do remember this. And before we talk about the type of exchanges, I just want to go over for the final time those 5 realtor rules I just gave you. Okay. Number 1, remember, anytime your client is selling investment held property, right? So this is for the investors, okay? Anyone that's selling investment held property, so land, commercial, residential, that's not their primary home. So long as when they sell and they buy equal or greater in value, right? Remember, we use the scenario of 500,000. So long as when they sell, they replace everything. They replace their basis, their gain, their mortgage, okay, into a new property to get up to the equal or greater in value. They'll have 100% tax deferral. So whatever price they sell for, if they buy again for equal or greater in value, they'll have 100% tax deferral. It's equal or greater, less your closing costs and commissions, okay? Number 2, remember what like kind means. It means any real property held for investment. So they can take commercial, buy residential, multifamily for condo, okay? Raw land for any of the above. They can sell one and buy multiple, or sell multiple to buy one, okay? Also remember your 3rd one, that vacation homes qualify so long as they're renting them out for at least 14 days per calendar year. Okay, so remember that 14 days over a 2-year, 24-month period, it qualifies each year. It qualifies as like kind. 3, remember there's a timeline and rules of identifying. Okay, remember the 45-day and the 180-day. And number 5, your most important realtor role is to know the exchange must be set up in advance in order to qualify. Even if we say Landmark Title is holding the relinquished property and they're going to wire direct, right, to ABC Title, the IRS still requires they have a qualified intermediary signing off that all exchange docs have been signed by all parties, and we can authorize Landmark to wire direct. Okay, so do remember that they must set up the exchange in advance in order to not have what's known as constructive receipt of funds. With that being said, there are 4 methods of exchanging. Okay, there are 4 types of exchanges, and the most common is what's called the delayed exchange. And that is also known as what was known before as the Starker exchange. Okay, and that is simply where your client sells, they have to buy again, that timeline starts, okay, and that's called the delayed exchange. The simultaneous exchanges, again, remember I mentioned where we allow Landmark to wire direct to ABC Title, okay? That's called a simultaneous exchange. Simply means it's happening the same day. Next, there's something called the improvement exchange. And this is where your clients can identify the property they want to buy and any capital improvements they want to do. And so long as they can complete those capital improvements with a general contractor that's not related to them, okay, having us involved, and they can complete all those capital improvements within 180 days, they can have a successful improvement exchange. So let me give you an example of that. Your client sold for 500. Remember I said we're going to talk about this number all day. And they found that perfect home for 200,000 that needs work, right? This is where the IRS allows them to do an improvement exchange, right? Maybe they identify landscaping, a pool, a new roof, right? So long as they can complete all those improvements and they can use up all of those funds to get up to the equal or greater in value, and all of those funds are tax deferred. Okay, great opportunity. A lot more goes with this, guys, but this is a tool and something they can use. And if it fits and qualify, they can qualify for that. Last but not least is the reverse exchange, and another one that we are seeing more common, so common right now. We are requiring a 14 days before close of escrow. The reverse exchange allows your clients to buy the replacement property first, and then they have 180 days to list and sell their property. What do you think happens? This stops the clock, right? That 45-day timeline that stresses everyone out, that keeps us up at night. Okay, even me, right? Keeps me up at night as well, knowing, okay, we've got someone that's coming up on their 45 days. This reverse exchange allows the client, the taxpayer, to buy the replacement property first, and then new agents have 180 days to help them list and sell. Okay, there are some things that have to go with this. Okay, they do need to make sure they have some money to buy the property. This is really important. I do want to let you guys know. Okay, it does require that they have the funds, let's say, to buy the property. Okay, either from a loan, from a lender. Okay, they need to have it, maybe their own money, maybe a loan from a family member. It doesn't matter where it comes from. They just have to basically have some stake in the game, right? To be able to buy the property first. And then when their property sells, they get to pay themselves back, and all those funds are tax deferred. Now, again, remember this, guys, this is a great opportunity here. Just some tools that your sellers may not know that they have. It's actually so common right now because of those 45 days that I want to let you guys know. It does require more involvement with us in advance. They cannot buy the replacement property first and then call us. We have to be involved a minimum of 2 weeks before close so we can make sure they can qualify. With that being said, I just want to let you know before I pass it back to the team here, but I do want to let you guys know there are so many benefits to do this, okay? I do want to give you a couple little tips too, okay? There's no added work for you as agents, all right? Gives you opportunities to serve your clients, right? Represent them on both sides. It really gives you that opportunity to know that if you can just really obtain one investor listing, just one a month, it's potentially 24 more transactions a year. Why? Because when they sell, they have to buy again. Also want you to keep a lookout and watch out. Agents can't say this enough, okay? Watch out for giving any buyer credits, okay? If you've got the listing that's an investment property, just want to let you guys know to watch out on giving any buyer credits, okay? Because remember that equal or greater in value we talked about? Credits are seen as if your seller or the exchanger, okay, doesn't matter what side they're on, when they give a credit for repairs, credit for closing costs, credits for rents and prorated security deposits, all of those are seen as if they took cash and they're taxed on it, even though they didn't. So remember that. If you can keep it outside of escrow, if you can lower the sales price, if you can have them fix the repair or do an as-is property, this is where they're going to have the most success and the least liability of tax for tax purposes. With that being said, the only thing I'm going to say about Old Republic Exchange is this is not a regulated industry. Let me explain that. Okay, you know how we have those RESPA laws, FERPTA laws? Okay, the qualified intermediaries are not regulated. And it is so surprising. We're talking about a tax code and anyone can be a QI. What does that mean? Anyone can open up their own shop and become a qualified intermediary. And if something were to happen to them, right, that they passed away, right, or the IRS thought there was fraud going on and there wasn't, see, your clients are the ones that don't, the ones that are in trouble, right? Now they're out of the property they just sold. They're out a whole lot of money. Income tax time, the IRS still wants their tax payment. So just want to let you guys know, because in our valley alone, there are some mom and pop shops. I love mom and pop, but not for the financial security. And also letting you guys know, as agents here, your referrals are directly tied to your license. So do remember this. Old Republic comes with the highest bond coverage in the industry, and we give a letter against fraud, errors, and bankruptcy. So if we close our doors tomorrow, their funds are protected, working with Old Republic Exchange. Do remember, can't say it enough, I'm not escrow entitled. That is why our team here has me. You cannot open escrow with us, right? You have to call your Landmark team. You would only open up the exchange with us. Those of you that have your phone in your hands, I know you've got your Landmark team on speed dial. I know you've got your preferred lender. Do you have a good qualified intermediary? Hang on to my information. And if you need anything, have any questions, please put them in the chat box. The team will take over from here. Hope you guys found some value and look forward to speaking with you soon.
Thanks, Sheila. We do have a few questions here from some agents, if you're ready
Great.
to answer them.
I am.
Let's see, the first one is, can an investor sell a home to a relative? Is there any special steps that will need to be done?
Great question. Yes, there are special steps when you sell or buy from a relative. Okay. And this is where I like to joke and say, if any of us taxpayers can get the upper hand anywhere, there's probably a rule against it. Okay. So here's what happens when you sell or buy from a related party. What is a related party? A spouse, right? Your parents, your children, your grandparents, your siblings, all of those are considered related parties. Now you can absolutely sell or buy from them so long as each party goes and exchanges and holds the property for 2 years. So let's just say you, as the exchanger, want to go buy mom's property. And you go, well, my mom's up there in age and she doesn't want to buy anything else. She'll just rent from me, right? I'll pay taxes on that rent. Well, that seems to make sense. But the IRS caught on to that. Too many people did that, got away with it, and now there's a rule against it. Okay. So what happens now is you can certainly go buy from mom, but now mom has to perform an exchange, being mindful of those crazy timelines. And both you and mom have to hold the property for 2 years or your exchange fails. So really, so important to know that and be aware of it, because that is common right now, especially in this market, right? Can I just go buy my sister's house, right? That seems to make sense, but unfortunately you cannot do it as easily as we'd hope.
Okay, thank you. Let's see, we also have one that says, how does a partial 1031 exchange work?
Great. Okay, so remember that first realtor rule I told you, right? They have to buy for equal or greater in value. But let's just say maybe they need to pay off a car loan, right, for $25,000 in order to even qualify for the new mortgage, right, to buy the replacement property, right? That is when they would say to the escrow officer, please withhold this amount, send it to me, and then send the rest to my exchange account. That's called a partial exchange. However, whenever your clients don't spend, right, the equal or greater in value, okay, or they touch any money, that money is turned into something called boot. And boot simply means taxable cash. And what that means is, say maybe your client sold for 500, okay, they took that 25,000, okay, or let's just say 50,000. Let's do easy math today. Okay, so they sold for 500,000, they took 50,000, and they're saying, I'm going to go reinvest the rest, right? Well, now that amount is subject to capital gains tax. And as a qualified intermediary, we have to say up to the extent of their gain. And why? Here's a couple things. You got the federal, you have the state, right? And where a CPA may be able to say, okay, let's do some prorations on that. If they say that, you cannot prorate depreciation recapture. So any money they touch, they can be taxed up to the extent of their gain, because the depreciation recapture must be paid back first before any other taxes are due. Okay, so partial exchanges are not always beneficial. Do they happen? Yes. I am going to let you guys know the best thing for you to do is tell your clients to get up to equal or greater, push them in my direction as the qualified intermediary. I'll give them the bad news, right? And they'll probably call you up and say, let's go ahead and buy a second property, or let's buy up in value.
Okay, and then another question is, if there is existing financing on the property sold, does that play into the qualification requirements of the new property?
Yes, they have to buy equal or greater. Remember that. Okay. So if they sell for 5 and say there's a $200,000 mortgage, right? When they go buy again, they don't just get to pay that mortgage off, right? And then go buy for the remainder, right? So they sold for 5, they have a $200,000 mortgage. Okay. When they go buy again, they need to buy equal or greater in value. So they need to replace that mortgage that they just paid off on the other property, right? They need to replace that mortgage with a new mortgage. So they need to encumber the same amount of debt or more in order to have 100% tax deferral to get to the equal or greater in value. So they need to either bring in the cash difference or go get with your preferred lender and get a loan, because they cannot just say, take that 300,000, right, and put it into a new property. They've got to get to the equal or greater in value. Really great question. Important information there.
Okay, great. We have a couple more. So this one's regarding the identify stage. Does that mean they need to identify if it's condo, residential, etc.? Is that what is meant by identifying what you buy?
Oh, yes. Wonderful. Let's talk about that. So I'm going to show you some sort of what an identification notice looks like. Okay. So remember, I said everyone has their own role, right? What is our role? To explain all these guidelines, making sure we're up to date with them, making sure your client understands them. Okay. And what we do is we provide them with something called an identification notice. Now, your clients can identify by contract or by written ID. And this is sort of what it looks like. Let me give you an example here. Okay. This is one of the ways to identify. So let's just say they identify the street address, 123 Main Street, Anytown, Arizona, and they need to sign and date it. Okay. Not that this is very legible for you guys to see this, but what I want you to know is we provide them with the forms. We remind them when their 45 days are coming. We remind them that they're almost up. And then we remind them at the end, if you want to make any changes, here's a new ID notice. Okay. So you do need to know as agents, right? They need to make sure they identify by contract or in writing that is signed and dated. I do sometimes get those text messages or emails listing a ton of properties saying, I'm going to pick one of these. And the IRS does require, there are rules of identifying how many they can and the timeline of when they need to get it in. So absolutely our role to review that with them and make sure, again, by contract or by written ID before the 45th day at midnight. Oh, sure. Beth, you're on mute.
Sorry, there was some background noise, so I muted it. I was just saying, it sounds like they're in great hands with you guys. And another question, let's see, we have, 2 more. Okay. How much time before a listing should be, or excuse me, before a listing should an exchange be put in place?
I'm always going to say, as soon as you know you've got a client, right, you've got that listing. I can't say this enough, right? If you can, you're always building as agents, right? Or those of you that might be new, I want to let you know this. You're building your preferred, partners, right? That's really what you're doing. And anytime that you have that opportunity to obtain a listing that's investment, okay? So remember, what's investment, right? Land, commercial, residential, right? That's not their primary, okay? And you go to have that first meeting with them. I always like to tell you as agents, don't just try to establish that relationship to obtain that listing, but think about the second potential sale as well. Because if you start getting them with your preferred partners, right, saying, hey, we're going to use Landmark for escrow, we're going to use, XYZ lending, and we're going to use Sheila as the qualified intermediary. You're going to put them in place. I'm going to be able to tell them those tax saving tips, like remember the credits, okay? So if you can let us know right away and we can be there with you through the process, that's going to save them. The next best thing too is if say they didn't tell you, then you want to get us involved once they have a buyer. Okay, so I always say get us involved in advance. I'm working with people that aren't closing till next June of 2022. Okay, so get us involved at least once they have a buyer And never wait till the closing table, agents. I can't say this enough, because your clients aren't filling out that information packet, that daunting information packet the escrow officer sends them. Some of them aren't even filling them out till they're at the signing table. So escrow has no idea there's going to be an exchange. And now you're running into tight timelines that could cause your escrow to be delayed. So your closing to be delayed. Okay, so remember that if you can get us involved right away, that's going to save them.
Okay, we still have a few more. These are great questions. Let's see.
Yes, they are.
Has the rule changed in which if a person fails to meet the 45-day to identify, where the funds are still tied up for full 180-day period?
Yes, this is something called, you have to watch out for. Let's get back to that slide here. I want to give you guys, and we're going deep here, guys, okay? So for those of you that are probably already overwhelmed, watch this again. Okay, there is something under, remember the 1031 is a tax code. 1031 stands for tax code. Under 1031 are all these restrictions, right? They're labeled, all these different letters and numbers. There is a restriction called the holding period, which is called the G6 restriction. This G6 restriction is the holding period in which starts the day they close. Here's what happens. Basically states that from day 0 to day 45, your clients are eligible to receive the funds only for earnest money deposits or close on a replacement property. Okay? They're only entitled to receive those funds for earnest money deposits, which go direct to escrow, okay, or to close on a replacement property. If they fail to identify or they properly cancel their identification notice by midnight of the 45th day, then under this restriction, they're eligible to receive the funds on day 46. Okay? So again, day 0 to day 45, they must close on a property or ask for earnest money deposits, and they can access those funds. If not, right, they're eligible to receive the funds on day 46. Here's the kicker, okay? Let's say they identify on day 45. And then day 46 they call, we identified in writing, Sheila, right? We sent you the ID notice, they signed and dated it by midnight of the 45th day, but day 46, all those properties they listed went to other buyers. So here's what happens. Now that they've identified in writing and they're past day 45 and they cannot close on any of those properties, this is really important, you guys, okay? In order for them to have a successful exchange, they need to close on one of those properties identified. If not, their funds are held and they're not eligible to receive their funds until day 181. So important you know this, because what do you think is going to happen there, right? They still want to buy something and now their funds are held because they didn't properly cancel their exchange in time. So important you have a good QI. Here's another reason why too, Beth. So important you've got someone that doesn't tiptoe around this holding period, right? Because you wouldn't believe how many times they make those mistakes. And then you as agents, you still want to help them sell and the client wants to still buy. And now not only are they going to pay tax on those funds, you can't even access it until day 181. So important to be mindful of that ID notice timeline.
Oh, good info. Okay, let's see. We have another one. I have an investor whom is under contract on his sale now, but is going to buy another investment property. Is it too late to do an exchange?
Say that one more time. They're in contract. Say that one more time, Beth.
Yeah, I have an investor whom is under contract on his sale now, but is going to buy another investment property. Is it too late to do an exchange?
Not at all. Remember, just so long as we get this set up right away, this is the time now to say, okay, hey, I want you to get with your qualified intermediary. Let's get this set up so that we can make sure, and they can go ahead and make offers now. So go ahead and let them know, go ahead and make offers. They don't need to wait till their sells in order to make offers on a new property, but now's the time. If they're in contract with the buyer, they absolutely want to get it set up with us in advance. The sooner the better, right? Because as you may know, right, all of us are going crazy with escrows and exchanges, right? And loan applications for our lenders. So if you can let them know now, this is the perfect time and help them go make offers on that new property. They can absolutely do that right now.
Okay, and we have two more. All right, this one, REITS rights or whatever are not
REITs.
qualified, question mark? What is that? Oh, yeah, I don't know that one.
Yes, REITs. So yes, they qualify. Let me explain though how a REIT can qualify, okay? Let's go to our like kind here, guys. So a DST, a REIT and a DST. Let me give you some acronyms for our gals that are on here on screen with me. You guys are probably like, what is that? Okay. So in order to use a REIT as a like kind property, they need to buy it through what's called a DST, which stands for Delaware Statutory Trust. Okay. That is where they're buying, say, a piece as tenants in common into like maybe an Amazon distribution or like a Mayo Healthcare. Okay. And they're taking maybe their 100,000 and they're buying a little 0.1% of a bigger property. So long as they can do this REIT through a DST and they are on titles as tenants in common, it qualifies as like kind. If they were just to simply take their funds and go buy a REIT through their financial advisor, then that's personal property and that doesn't qualify. So remember that only real property qualifies, and a DST, so a REIT through a Delaware Statutory Trust, qualifies as like kind.
Okay. And then
Anyway, okay, that's a lot. Yeah, that's one for those that know. So a whole nother class we can do, ladies.
Yeah, we might have to do that 1031 too. And then the last question I have here is, can an investment home be switched to a primary home? For example, a vacation home used for 5 years as such, and the owner decides to move in. Is that possible, assuming the tax will be due at that time?
The simple answer is yes. Let me explain how that works. So like kind means held for investment. At the time of acquiring it, the IRS is looking at, did you hold this for investment? Most tax advisors suggest holding the property as investment for 2 years or more before turning it into personal use. We as QIs, again, exchange accommodators, qualified intermediaries, suggest holding the property the longer, the better. Do not move into that property any less than 2 years, and make sure you have the blessing basically of your tax professional, your CPA, before you go move into it. And yes, that is a great way to estate plan and turn that last investment property into your forever home.
And all right, we have another question that just popped up. Can you explain the 200% rule?
Okay, we're going deep again here, Beth. Okay, remember I told you there's rules. Remember the fourth tip I said? There's a timeline and rules of identifying. I will only go over the rules of identifying if someone asks, because this is where your head will start spinning. Okay, let me explain something. Okay, don't mind our screens going back and forth. Okay, so remember we've got this timeline, right? They have to identify within 45 days and they have rules. There are 2 rules with an exception to the second. What does this mean? This means that the taxpayer, the exchanger, right? The one selling the property and doing the exchange, they can only identify so many properties. Gotta love our IRS giving us rules here, okay? The IRS states that they can identify under 2 rules. And the first one is they can identify, right, in writing under the 3 property rule. That means they can only identify 3 properties at any value. Okay, so they can identify 1, 2, or 3, but no more than 3. So they can identify under the 3 property rule any value in any type, but no more than 3. Or they can identify something called the 200% rule. And this is for anyone that wants to identify 4 or more. Okay, let me explain this. The IRS states they can identify any number of properties, right? So long as the fair market value of all the properties does not exceed double of what they sold for. What do you mean, right? Okay, remember our client that just sold for 500,000? The IRS states they can use this rule, so they can identify 4 or more, right? They sold for 5, but the total fair market value of all the replacement properties in this scenario cannot exceed more than $1 million, double of what they sold for. Now you can find this is quite challenging, right? Because if you've got someone selling for 200,000, that's really going to limit the number of properties and the total fair market value. Okay, this is the most common rule, guys, that we're seeing. Most people are identifying 1 to 3. Okay, unless they're doing those DSTs, remember the one you were just talking about, right? Those REITs through a DST. Okay, this 200% rule, we are very rarely seeing this because there are so many errors that can be made. And if your client over identifies, then they have a failed exchange. Okay, so again, remember the 3 property rules, the most common. 200% is simply when they want to identify 4 or more. The total fair market value of all combined added up may not exceed more than double of what they sold for, unless they plan on buying everything they identify. So again, all I can say right here, Beth, is to make sure you have a good qualified intermediary agents. Don't go out of your lane with this one. You can see right here, some of your heads are spinning. You're like, why did he ask that question, or she? Well, it's such a crazy rule under the tax code. This is something I go through with your clients, not our first conversation, right? Or I'd make their head spin. But I do want to let you know, we do clearly put this in writing, making sure they understand, and we handhold, making sure they do not have a failed exchange because of identification purposes.
Great. And then we have, a couple compliments, actually. Sheila, you are awesome. And then someone else said, this was awesome, Sheila. It's obvious you are very knowledgeable on this topic. Thank you. So, and I feel the same way. This was super informative, great information. And I learned a ton on 1031 exchange. So even though I'm not an escrow officer and I don't deal with it personally, this will help me as well. So.
Absolutely. And remember, as you guys are there, lean on us. We all work together here. And if you're not comfortable asking questions in this format, or you want a refresher, shoot me an email. I'm happy to, handhold. And again, no question's a bad one. We can always do follow-ups later on. So please let me know where I can assist.
Yeah, this was amazing. Did Becky or Sarah or Melinda, did you have anything to add, or?
It was fantastic. I learned something too. Like I've been through 1031 classes before, but yeah, there's so much to learn, about it. It's great. Thank you.
Yes, thank you, Sheila. That was really awesome.
And,
thank you, ladies, for having us. We'll plan this again, and let me know if you have any questions. So thank you.
Okay, great. And we'll see you again soon. We'll get the date squared up for the next 1031 exchange. That will be opened like everybody on Zoom. We wanted to do one for DPR first because they are special clients. So they got the privilege of the first one, and then we're going to do a few more because this is just a great class, and I think it's great, wonderful information for agents. So thank you so much, Sheila. We really appreciate your time and teaching this class.
Great. Thank you, guys. Have a great day.